There are as many as 44 AMFI registered fund houses in India that together offer more than 2,500 mutual fund schemes. The wide array of funds often make it a little difficult for investors to choose the best scheme. Therefore, I decided to come up with a mutual fund education series that will help investors make better investment decisions. In today's video, we will uncover 5 broad mutual fund categories and explore different funds offered in each of these categories. Mutual fund schemes can be structured as open-ended and close-ended schemes. An open-ended scheme continuously allows investors to buy or sell units of the fund at market value or net asset value. The scheme is perpetual unless the investors decide to wind up the scheme. The asset under management for open-ended schemes keep varying as investors keep adding or selling units in the fund. A close-ended scheme, on the other hand, has a fixed duration. Investors are allowed to buy units only during the new fund offer period, and transactions are closed once the NFO window is closed. The fund is mandatorily listed on the stock exchange, where investors can sell the units to other investors. The asset under management remain unchanged over the life of the scheme. The units are redeemed at the end of the term at the prevailing NAV, and the fund ceases to exist. SEBI has broadly defined the process of categorizing open-ended mutual fund products into equity schemes, debt schemes, hybrid schemes, solution-oriented schemes, and other schemes. Equity fund schemes invest in a portfolio of equity shares and equity-related instruments. The risk and return from the scheme are similar to that of directly investing in the equity markets. Equity funds are further categorized based on the strategy adopted by the fund managers to manage the funds. Passive funds invest the money in the companies represented in an index such as Nifty or Sensex in the same proportion as the company's representation in the index. The fund managers do not make any investment decisions such as where, when, and how much to invest. Active funds select stocks from the portfolio based on the strategy defined by the fund managers, which is intended to generate higher returns than the index. Diversified equity funds invest across segments, sectors, and sizes of companies. Since the fund manager takes exposure to different stocks across sectors and market segments, there is minimal impact of poor performance in a specific sector on the fund. Equity funds focus on a particular size of companies based on the market capitalization. The open-ended equity schemes are classified as follows. Large cap funds invest in stocks of large, liquid blue chip companies with stable performance and returns. These companies are ranked 1 to 100 in terms of market capitalization in the list published by AMFI. The fund must invest at least 80% of the total AUM in large cap stocks. Mid cap funds invest in mid cap companies that have the potential for faster growth and higher returns. These companies are more susceptible to economic downturns and hence require careful evaluation before investing. The companies are ranked between 101 to 250 in terms of market cap. The fund must invest at least 65% of the total assets in such companies. Small cap funds invest in companies with small market capitalization and intend to benefit from higher returns. However, the risks are also higher. The companies are ranked 251 onwards in terms of market capitalization. The fund must invest at least 65% of the total assets in such companies. Multi-cap funds invest across large, mid, and small cap companies. The fund must invest at least 75% of total assets in equity, with a minimum of 25% in large cap, 25% in mid cap, and 25% in small cap. Recently, a new category called flexi-cap funds was introduced, where there is no minimum investment limit across market caps, and the fund is free to invest according to the requirements. Sector funds invest in companies that belong to a particular sector, such as technology or banking. The risk is higher due to the concentration of investment in one particular sector, as the sector's performance tends to be cyclical and the returns vary across time frames. Investment in the sector fund must be timed well and requires a certain level of business cycle understanding to make the right decision. Theme-based funds invest in multiple sectors and stocks that form part of a theme. For example, an infrastructure fund will invest in steel, construction, cement, banking, and logistics stocks. They are more diversified than sector funds but still carry concentration risk. The strategy adopted by the fund manager to create and manage the fund's portfolio is a basis for categorizing funds. The open-ended equity funds are categorized based on this principle as follows. Value funds seek to identify companies that are trading below their intrinsic value, with expectations to benefit from an increase in the price when the market recognizes the true value. Value funds are low-risk funds, but they need a longer time horizon for the theme to play out. Contra funds adopt a contrarian investment strategy. The funds identify undervalued and beaten down stocks and sectors. The fund invests in such stocks which are seen as cheap relative to their long-term fundamental values. Dividend yield funds invest in stocks that have a high dividend yield. Such companies have stable earnings but do not have much potential for growth or expansion. The stocks are bought for their consistent high dividend paying ability rather than for growth or capital appreciation. Focused funds hold a concentrated portfolio of securities. As per SEBI regulations, the fund is not allowed to invest in more than 30 stocks. Equity-linked savings schemes are a special type of open-ended equity funds that provides the investor with tax deduction benefits under Section 80C, up to a limit of 1.5 lakh. The investment made by the investor is locked in for a period of 3 years. Debt funds invest in a portfolio of debt instruments such as government bonds, corporate bonds, and money market securities. Debt investments have a predefined income stream. Bonds issued by the government has no risk of default and thus pay lowest coupon income relative to other bonds of same tenure. Corporate bonds carry a credit risk or risk of default, hence pay a higher coupon to compensate this risk. The credit rating of the instruments is used to assess the credit risk, and higher the rating, lower is the perceived risk of default. The debt instruments' prices or value may change based on the interest rate fluctuations. Debt with longer maturity tenure are sensitive to interest rate fluctuations. Fund managers make choices on higher credit risk for higher coupon income and higher interest rate risk for higher capital gains depending on the nature of the fund and their revaluation of the issuer and microeconomic factors. Debt instrument can be classified based on the types of securities they hold in the portfolio in terms of tenure and credit risk. Short-term debt funds aims to provide superior liquidity and safety of principal amount. It invests in very liquid, short maturity fixed income securities of highest credit quality which helps keep interest rate and credit risk low. The objective of these funds is to generate steady interest income with minimal fluctuation of fund NAV. The open-ended schemes are classified as follows. Overnight funds invest in securities with a maturity of 1 day. Liquid funds invest in debt securities with less than 91 days of maturity. Ultra short-term funds invest in debt and money market instruments such that the Macaulay duration of the portfolio is between 3 months and 6 months. Low duration funds invest in securities with Macaulay duration of the portfolio is between 6 months to 12 months. Money market funds invest in money market instruments having maturity up to 1 year. The next category of debt funds combines short-term debt securities with a small allocation to long-term debt securities. These funds combine the benefits of stable interest income from short-duration debt instruments with capital gains from long-term securities. Open-ended schemes investing in the above manner are categorized by SEBI in the following manner. Short-duration funds invest in debt and money market instruments such that the Macaulay duration of the portfolio is between 1 year to 3 years. Medium duration funds invest in securities with Macaulay duration of the portfolio is between 3 years to 4 years. Medium to long duration funds invest in securities with Macaulay duration of the portfolio is between 4 years to 7 years. Long-term funds are structured to generate total returns made up of both interest income and capital appreciation from the securities held. As the securities have longer maturity periods, their price is subjected to fluctuations due to interest rate risk and credit risk. It is important to note that market interest rates and value of the bond are inversely related. As a result, in a falling interest rate scenario, the bond value will go up and hence the long duration funds will give higher returns. Corporate debt securities are subject to credit risk and hence they offer higher interest income compared to government debts. The difference is generally known as spread. These long-term debt funds are categorized as long duration funds invest in debt and money market instruments such that the Macaulay duration of the portfolio is greater than 7 years. Corporate bonds funds invest at least 80% of total assets in corporate debt instruments with rating of AA plus or above. Credit risk funds invest a minimum of 65% of total assets in corporate debt investments rated AA and below. Banking and PSU funds invest a minimum 80% of total assets in debt instruments of banks, public sector undertakings and municipal bonds. Open-ended gilt funds invest at least 80% of the total assets in government securities across maturities. Gilt funds are popular with investors mandated to invest in government securities such as PF or PF trusts. Gilt funds with 10 years consistent duration will invest 80% of total assets on government securities such that the Macaulay duration of the portfolio is equal to 10 years. Dynamic bond funds have no restrictions with respect to security types or maturity profiles that they invest in. The main goal of the fund is flexible and dynamic management of interest rate risk and credit risk. Hence, based on the market scenario, they can move across the yield curve. The next category of mutual funds is called hybrid funds, which invest in a combination of debt and equity securities. Percentage allocation to each asset class will depend on the objectives of the fund set by fund manager. As a result, the risk and return of the schemes will depend on the allocations defined. Hybrid funds with higher allocation to equity will increase the risk and the expected returns. If the scheme has short duration debt allocation, then the interest income is stable and risk is lower. However, long duration debt securities will have high fluctuation of prices. SEBI has classified open-ended hybrid funds as follows. Conservative hybrid funds invest minimum of 75% to 90% in a debt portfolio and 25% to 10% of total assets in equity. The scheme mainly invests in short-term debt instruments which generate regular income and has low credit and interest rate risks. The equity exposure is limited to only large cap blue chip companies. Balanced funds invest 40 to 60% in debt instruments and 60 to 40% in equity instruments. Aggressive hybrid funds are predominantly equity-oriented funds, investing between 65% to 80% in the equity markets and 35% to 20% in short-term debt instruments. Balanced advantage fund dynamically manage investment in equity and debt instruments. The fourth category of funds are solution-oriented schemes like retirement funds, which are oriented towards savings for retirement. These schemes will have a lock-in for at least 5 years. Children's funds are schemes oriented towards savings for children's needs. The final category of mutual funds is called other funds, which include a funds of fund is a mutual fund that invests in other mutual funds. It cannot invest directly into debt or equity instruments, but will invest in other mutual funds as part of the portfolio. The fund manager specialized in analyzing the performance and strategy of different mutual funds will take decisions to add or remove funds based on the findings. Exchange traded funds holds a portfolio of securities that replicate an index and are listed and traded on the stock exchange. The risk and return of an ETF is directly related to the underlying index or asset. The ETF prices are real time, unlike NAV of mutual funds, which is computed at the end of the business day. Gold ETFs have gold as the underlying assets so as to provide investment returns that closely track the performance of domestic prices of gold. For equity unit of ETFs issued, the fund holds gold in the form of physical gold of 99.5% purity. I hope this video provided good understanding of the entire mutual fund landscape and different products available in the different categories.